Welcome to Using Expected Value to Enhance Profitability. One of the advantages of investing with options is that mathematical models can be used to compute a theoretical value for the options. The theoretical value can then be compared to market prices to determine whether trading opportunities exist. Using some of these statistical techniques that underlie option pricing, one can also construct measurements of option performance. One such measurement is expected return. Expected return is a statistical measure of a position's estimated return on investment. In this presentation, we will first examine the calculation of expected value. The expected value is used in many diverse industries and situations, including manufacturing, medical research, gaming, and finance. It is also the basis for the computation of expected return. The first section examines how expected value is calculated and provides examples on how casinos use probability and expected value to make their profits. Unlike casino games where the probabilities are known and constant, those associated with an option position's expected profit are based on assumptions about future market conditions. The second section shows how to calculate the expected profit for an option position with an emphasis on how to compute the probabilities. Simply using expected profit to compare positions is not sufficient to make an informed decision. A position with a high expected profit may entail a large amount of risk. A position with a lower expected profit and lower risk may be more desirable. The final section examines how expected return is calculated and used to compare positions. As you will see, calculating expected return is a somewhat complex undertaking. In the final section, we will see the basics of how to use Option Workbench to look at expected return and compare positions. After earning a bachelor's degree in computer science with a minor in math in 1984, I began my career as a software engineer in the financial services industry. Over the last 30 years, I have developed applications and systems for traders, portfolio managers, and risk managers for many types of organizations. I began trading stocks for my own account in the late 80s and moved on to options in the late 1990s. I'm now the owner of Hilco Financial Software. In addition to consulting for financial services companies, we are marketing the pre-trade analysis tool for option traders called Option Workbench. Option Workbench helps traders to find opportunities, compare strategies, and perform risk analysis. As part of its strategy comparison and risk analysis toolset, Option Workbench employs the techniques covered in this presentation. In plain language, the expected value is the best estimate of a value at some time in the future. The estimate is calculated by computing the weighted average sum of a set of possible values. Ideally, we'd like to use all the possible values to calculate the expected value, but that is not always possible. In general, the weighted average is calculated using this formula, where each value x is multiplied by a weight represented by w. For a simple average, the weight associated with each value is 1 divided by the total number of values, or n, in the formula. For the expected value calculation, the weight for each value is the probability of that value occurring. The probability associated with a particular value is found by taking the ratio of the number of times a number can occur divided by the total number of observations. A simple example of this type of calculation is the roll of a single die. The probability of rolling any of the numbers on the die is 1 out of 6, or 16 2/3%. To make this a little more interesting, suppose a game was constructed where a player picks a number from 1 to 6 and rolls a fair die. The operator pays out 3 to 1 on the bet if the player's number comes up on the die. So if the player bets $25, the operator would give them back $100, their $25 bet plus $75. At first glance, this might seem like a good way for the operator to lose $75, but applying the expected value calculation reveals a different story. The two possible values for this game are -75 and +25. The operator of the game pays out $75 1/6 of the time, and the probability of them keeping the $25 is 5/6. So the expected value of this game is 8 1/3. In other words, on average, the operator would expect to make $8.33 per bet. This also illustrates that the expected value need not be one of the possible outcomes. To drive home this point, consider the expected value of a roulette wheel from the perspective of the house. A roulette wheel has slots numbered 1 to 36, half of which are colored black and the other half red. There are 2 additional slots numbered 0 and 00 colored green for a total of 38 slots. There are 2 main types of bets that can be made at a roulette wheel. In the first type of bet, the gambler picks a number from 1 to 36, and if that number comes up, the gambler gets paid 35 times the amount bet. In the second type of bet, the gambler picks a color, black or red, and if the color comes up, the gambler receives a 2-to-1 payout. So if $1 is wagered on red and the ball lands on a red slot, the bettor gets back $2. What is the expected value per $1 bet for the casino? The first type of bet, the casino pays out $35, 1 out of 38 spins, and keeps the dollar 37 out of 38 spins. This gives the casino about a 5 1/4 cent expected value per $1 bet. For the second type of bet, the casino pays $1 18 out of 38 spins and keeps the dollar 20 out of 38 spins for the same 5 1/4 cent expected value. So on average, the casino can expect to make 5 1/4% for every bet at a roulette wheel. If you consider the billions of dollars in revenue generated by the gaming industry every year, it's apparent that if you can play enough games with a positive expected value, your expectations don't need to be very high. This is all very interesting for casino operators and traveling dice games, but how does it pertain to trading options? Recalling the definition of expected value, the weighted average value of a random variable, we first need to determine which variable we want to model. Since the goal of placing a trade is to earn a profit, we want to determine what the expected profit of the trade is before putting it on. If the expected profit is positive, on average we can expect to make a profit on this trade. If the expected profit is negative, we should not do the trade. As a simple example, consider an at-the-money $50 call with 90 days to expiration. With the stock price at $50, the position is put on for a debit of $2.50. Since the expected value of an option is partially derived from the price of the underlying, the expected profit can be calculated using the underlying price as the random variable. This table shows how the expected profit at expiration can be calculated. The table shows 9 possible values of the underlying stock price at expiration, the probability that the stock will be at that price in 90 days, the value of the call for the underlying price, and the P&L of the position. The final column shows the product of the profit and probability columns. Each cell in the probable profit column corresponds to a term in the weighted average sum formula we saw earlier. At the bottom of the probable profit column is the expected profit of $1.85. Analysis of the data in the table reveals some important properties of the expected profit calculation. 2 principal differences from the die roll and roulette wheel examples are evident. First, in practical terms, all possible values of the random variable cannot be known. Since the price of the underlying can take on any value between 0 and infinity, a range of prices will need to be selected that will give us enough confidence in the resulting expected profit. In statistics, this range is called a confidence interval. The second question is, how do we determine the probabilities? Whereas the probabilities for the casino games are known and constant, the probabilities used to calculate the expected profit are dependent on an assumption about the price volatility of the underlying asset. Option traders are typically attempting to make a profit over a range of the underlying price. So as stated on the previous slide, since we cannot use all the possible prices, we need to pick a range that will give us enough confidence in the expected profit. Predicting this range also depends on an expectation of the volatility of the underlying price over time. Since volatility measures the standard deviation of underlying price returns, we can use standard deviations to determine the range of prices for the desired confidence interval. Professional risk managers typically use an interval from -3 to +3 standard deviations because that range corresponds to a 99.7% confidence. From a statistical perspective, this means that the underlying price return should fall within that range for 99.7% of the observations. This formula shows how to calculate what the underlying price is for a given number of standard deviations. P sub 0 is the current price, E is the natural exponential constant. In statistics, the Greek letter sigma is commonly used to designate the standard deviation, or volatility in this case, and n is the number of standard deviations. For the long call example, let's assume a 25% annualized volatility. The first step we need to take is to scale the volatility to the 90-day period to expiration. This is accomplished by applying the square root of time rule and results in a 14.94% volatility. For the 99.7 confidence interval, the price at -3 standard deviations is $31.94, and the price at +3 standard deviations is $78.28. The next question that arises is how to pick the prices in between the endpoints. Using the equation on the previous slide, P sub n can be determined for any number of standard deviations, so the objective is to pick some increment of n that will result in enough prices to obtain an acceptable sampling, but not so many prices as to make the calculation too time-consuming. As it turns out, this is closely related to how the probability of the underlying price being at that level is determined. So now let's turn our attention to how to calculate the probabilities and tie it all together later. In 1973, Fisher-Black and Myron Scholes published a paper defining the now famous Black-Scholes option pricing model. One of the characteristics of the Black-Scholes model is that it assumes that the underlying asset's daily returns follow a log-normal distribution. The reason for this assumption is so that the model can estimate the probability that the option will expire in the money and earn a profit for the option buyer. There are two concepts that need to be understood in order to compare how the probabilities are calculated: the probability density function, or PDF, and the cumulative density function, or CDF. This figure shows a typical normal probability density function. The PDF tells us the frequency at which we can expect the log return to change by a certain number of standard deviations. However, this is not the probability. As indicated in the diagram, the probability is represented by the area under the PDF. Taking the sum of the numbers representing the area between -3 and +3 standard deviations results in the 99.7 confidence interval. To calculate the probabilities needed to arrive at the expected profit, we need to know the area under the PDF curve for the number of standard deviations represented by the price change. This is accomplished by using the cumulative density function, or CDF. This chart shows the CDF for the normal distribution depicted on the previous slide. It is important to note that a point on the CDF designates the probability of the random variable being less than or equal to the point's x value. Therefore, the probability of the price moving 0 or less standard deviations is 50%. Likewise, the probability of the price moving more than 0 standard deviations is 50%. How did this help us derive the probabilities we need to calculate the expected profit? Another property of the CDF is that it can be used to calculate the probability of the price falling in an interval on the curve. This is accomplished by subtracting the probability at the lower end of the interval from the probability at the upper end of the interval, as shown in this formula. Referring back to the expected profit example from earlier, the probabilities stated in the second column were actually determined by using the formula above and a $5 interval. So the 23.82% probability of the underlying being at 55 is actually the probability of the price being between 50 and 55. For that simple example, a $5 interval was sufficient. However, for actual trading, a much smaller interval is needed. Before deciding on what interval is appropriate, there's a trade-off that needs to be considered. In the example position, computing the probability and the value of the call are both multi-step complex calculations. As such, performing these calculations too many times can consume a great deal of computational resources. Since a stock price cannot move less than 1 penny, it may be tempting to pick a small interval around a penny. For example, the interval at a half cent above and below the price will yield a very precise probability. In the examples, the range from $31.94 to $78.28 would result in 4,634 prices to consider. If the volatility were to increase to 50%, the number of calculations goes up to 10,214. As it turns out, the differences in the probabilities using the 1 cent range are so minuscule that the extra computations are not worth the effort. A better solution that results in more than adequate results is to divide the range into equal-sized chunks. The objective is to choose a chunk size that results in a small enough difference in the probabilities without incurring undue computational expense. Given that the endpoints of the range are defined as -3 and +3 standard deviations, it makes sense to use an increment of standard deviations to divide the range. For example, using 1/128th of a standard deviation, a nice round computer number, divides the 6 standard deviation range into 768 chunks. This table shows a revision to the long call example. A new column showing the number of standard deviations has been added. So as the table shows, this long call still has a positive expectation. If a trader could buy a call like this many times, on average, a profit of $76.33 per contract would be expected. The preceding examples assume that the price returns of the underlying asset follow a log-normal distribution. Very few, if any, equities or instruments of any asset class actually exhibit this behavior. In the real world, price fluctuations are subject to shocks caused by corporate actions, natural disasters, political turmoil, and other exogenous events. Single-day price moves of 4 or more standard deviations are not uncommon. This means that the probability of extreme changes is higher than would be predicted by the normal distribution, leading to the understatement of the probable profit at the extremes or tails of the distribution. This fact calls into the question the value of using the standard statistical techniques outlined above. In fact, there are many techniques employed by professional risk managers that apply adjustments to the normal distribution. These so-called parametric approaches attempt to account for the extreme fluctuations in a generalized way. There are also non-parametric or empirical approach that can be used. This method uses historical data to construct the PDF and CDF. The empirical approach is not generally used by professional risk managers because they are typically dealing with large portfolios of diversified assets, and a more generalized approach is appropriate. However, for the purposes of calculating the expected profit for an option strategy, using empirical data is a reasonable approach. In the normal PDF exhibited above, the tails of the distribution decline smoothly and approach zero as the standard deviations approach negative and positive infinity. This chart, generated by Option Workbench, is an example of an empirical fat tail PDF for the S&P 500 index. The daily returns were collected for a 10-year period ending in June of 2013. In the histogram, the 8 standard deviation range from -4 to +4 standard deviations is divided into 128 buckets. The height of the bars indicates what percentage of the daily returns falls into each bucket. The histogram is superimposed over a normal distribution to illustrate the differences in the tails. Using the empirical PDF, a CDF can be constructed. This chart from Option Workbench shows the CDF derived from the PDF on the previous slide. The red line depicts the empirical CDF, and the blue line shows the log-normal CDF for comparison. One difference between the two that is immediately apparent is the log-normal CDF is smooth and continuous, whereas the empirical curve is not smooth and is not continuous. The SPX PDF used to construct the CDF is missing some bars in some of the upper end buckets. Even if all the buckets contain data, the empirical CDF would still not be continuous. Furthermore, recall that to calculate the expected profit of an option position, a very small increment of standard deviations was used. Since the log normal CDF is a continuous function, a value for any number of standard deviations can be computed. This is not the case for the empirical CDF. So for values that are not points on the empirical CDF curve, an interpolation method will need to be used to determine the probabilities. One of the trade-offs between using an empirical CDF versus the log normal CDF is that the former offers an accurate approximation of tail risk, while the latter offers a better approximation of the probabilities. Another point to consider is what data are used to construct the PDF. If the SPX PDF were constructed using only 3 years of daily data, the 2008 financial crisis would not have been included. There are valid reasons for selecting both timeframes depending on circumstances. One could also choose to use weekly or monthly returns to construct the PDF. All of these choices will affect the shape of the CDF. In summary, a fat tail distribution can offer a better estimate of expected profit, but there is not one correct fat tail distribution. An option trader who would like to use a fat tail distribution should be aware of what assumptions were made in constructing the PDF. While having expected profit is preferable, it is not always sufficient. A trade with positive expectation can still result in a loss, so attention must be paid to risk. Expected return, the expected profit divided by the risk, tells an option strategist whether the trade is worth the risk. In the long call example above, the risk is $2.50, the cost of the call, so the expected return is approximately 30.53%. Suppose now that the cost of the call was actually $3.15. That would reduce the expected profit to approximately 12 cents for an expected return of 3.65%. So even though the trade still has a positive expectation, a return of 3.65% does not seem worth the risk. This conclusion is subjective and has to be weighed against alternative uses of the trading capital. Perhaps 3.65% is not a bad return given general market conditions. This type of comparison highlights another use of expected return. Similar to the comparison on the previous slide, different positions can be compared using expected return. The final step is to normalize the returns. Normalization is necessary because the positions under consideration may have different strike prices, times to expiration, and even different underlying assets. Suppose a trader wants to compare the long call analyzed above with a 45-day call for a price of $1.85. The expected profit on the new call position is approximately 39 cents for an expected return of 21.25%. The question is, would the trader prefer a return of 21.25% over 45 days or 30.53% over 90 days? The reason this needs to be considered is that the proceeds from the 45-day trade can be reinvested for the 45 days between the two expiration dates. This equation shows how to calculate the compound annualized return. Using this formula, the original 90-day trade yields 294.65% on an annualized basis, and the 45-day trade yields 477.36%. This shows that the 45-day call has an edge over the 90-day call, and the trader should prefer the new position. I have opened Option Workbench and navigated to the analysis dashboard for the S&P 500 Index SPX. Clicking on the link or the chart image opens the probability analysis page. Using the time frame control, I can change from 1 year, the default time frame, to 2, 3, 5, or 10 years. Changing the time frame from 1 year to 10 years We can see how the shape of the probability density more closely resembles the log normal PDF, with the addition of the fat tails that we would expect. In the probability density histogram, the daily returns are converted to standard deviations and placed in the appropriate bucket. Each bucket covers a 1/16th standard deviation range. Returns outside the range are placed into the appropriate extreme bucket. For example, a daily return of -4.5 standard deviations is placed into the -4 to -3 7/16 bucket. In the upper right corner of the page is a text box that shows the average daily return, the daily volatility, and the annualized volatility of the returns that make up the probability density chart. Changing the time frame again from 10 years to 3 years, we can also see how the empirical cumulative density curve, the red line in the lower chart, changes shape. In particular, notice how the tails of the curve become thinner as the middle section of the curve shifts around 0 standard deviations. The CDF also becomes less smooth, reflecting the discontinuities caused by the empty buckets on the probability density histogram. All of these changes in the shape of the CDF curve will change the probabilities that go into the computation of the expected return. Now let's see how to use expected return to compare strategies. Using a filter in the Covered Calls profile page, I have identified two potential opportunities for IBM and added them to the strategy analysis page. The spread summary table shows information for each position, including the expected profit, expected return, and annualized expected return. Option Workbench uses the expected risk as the denominator in the expected return calculation. The expected risk uses the same statistical techniques as the expected profit to estimate the worst-case scenario for the spread under analysis. In this case, although it is possible, it is not likely that IBM will move down to 0 for a complete loss. So the expected risk tells us, on average, the risk associated with the position. The rows in the table can be sorted by clicking on the column header. The first click sorts the rows in ascending order, and the second click sorts them in descending order. I have sorted the rows in descending order by annualized expected return. As I change the volatility assumptions underlying the calculations, the rows will be resorted automatically so that the spread with the highest annualized return is always in the top row. Notice that even though these trades were identified as potentially profitable on the strategy zone, Option Workbench is indicating that each has a negative expected return. The reason for this is that Option Workbench attempts to present a conservative analysis by default. Since the gamma of a covered call is negative, indicating that the position benefits from a low volatility environment, Option Workbench chooses a high volatility as an input into the expected value calculations. In this case, Option Workbench chooses the greatest of the 20, 50, and 100-day historical volatility readings. Suppose we believe that the realized volatility will be closer to the 50-day reading of 16%. To change the value used in the computations, open the Volatility Shifts window and type the new value into the Historical Volatility field. Click the Apply button to recalculate the values. The 200 strike position now has a positive expectation and moves to the top of the spread summary table. Applying the same change to the 195 strike position, now shows that position with a positive expectation and a better annualized return than the 200 strike spread. To switch to a fat tail distribution, open the Volatility Shifts window again and click the Fat Tail CDF radio button. To choose a time frame, open the drop-down box and select the desired value. In this case, I will choose 5 years and click the Apply button again. To complete the analysis, I will make the same assumptions for the 200 strike position. Using the 5-year empirical CDF now shows that the 200 strike spread has an edge over the 195 strike position. Given our assumptions about volatility, we should prefer the 200 strike covered call position. Using expected value can help people to predict possible outcomes in many different areas. Casinos use probability and the expected value of the games that gamblers play to give the house an edge. By carefully establishing and maintaining positions with positive expected returns, option traders can use probability and statistics to enhance portfolio returns and, in a sense, be the house. For more information pertaining to Option Workbench, please visit our website www.optionworkbench.com or contact us at support@optionworkbench.com. To download the white paper upon which this presentation is based, please visit www.optionworkbench.com and complete the download form on the home page.